Jobs Day like Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We had a down day on futures this morning. Then we had GDP data come out, a very positive surprise, and that kind of turned things around a little bit. So now you can see the S&P futures are unchanged. NASDAQ and Russell futures are rising as we hear the opening bells, which, by the way, are really interesting today because we have a couple of IPOs. On the New York Stock Exchange, Concentra starts trading today. They operate some company-sponsored healthcare plans. And then Lineage, the cold storage company that we're going to interview in just about an hour's time. So really interesting IPOs may be coming back into the fray. Let's get a check on the major averages with Katie Greifeld. Katie?
Well, like you said, Matt, a little bit of a turnaround going on this morning. You'd see the S&P 500. It's higher, just marginally, but still, that looks pretty good after what we saw yesterday in terms of the worst day in almost 2 years. Big tech up a little bit as well. The NASDAQ 100 up about 0.1% in the first moment of trading. And that rotation, maybe it's back, at least for this exact moment. The Russell 2000, those small caps currently leading the way up about 0.3%. But one stock we're keeping an eye on is Hasbro, surging after the toy maker beat expectations for its second quarter results in Chanel. You can see shares currently up about 6.6%.
A lot of divergence in this market, Katie. I'm also keeping an eye here on Ford continuing its plunge after second quarter profit. That fell short of Wall Street estimates. You have Ford down in the middle of, or the moment the market opens, at almost 14%, more than 13% this morning.
All right, and American Airlines, those shares are lower after the airline slashed its earnings outlook for the year. We want to take a closer look at the airlines at large. For that, we go to Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, there's lots of pain here for airlines. The trend continues as demand for the current quarter, this all-important summer season, simply not materializing. Let's start off with Southwest. They're well off the lows. These shares down just 0.3%. Earlier, down about 3%. They beat, but they also cut the current quarter outlook, the third quarter outlook, because of this air pocket in demand. And they, in addition, in a real shift, they're offering assigned seating and premium offerings. You have to wonder what that's going to mean for those super loyal Southwest Airlines customers who like it the way that it is now. Time will tell, of course, on that. And then American Airlines down sharply. As you were mentioning, they slashed the profit outlook. The second time they've done this year, the stock down 4% into today, already down 26% year to date. The CEO admitting that they really got the demand picture wrong. Plus, one sales strategy around certain corporate customers not paying off. Again, these airlines down sharply, Katie.
Absolutely. An ugly day for those airlines. Abigail Doolittle, thank you so much. And let's keep the conversation going with Michael Kantrowitz. He is Chief Investment Strategist over at Piper Sandler. And Michael, there are so many cross currents right now between politics, of course. You have earnings underway, and then you have the Fed coming up next week. Take us through what your takeaway is right now. What is the ball that you're keeping your eyes on?
Well, I think, investors have continued to be very myopic. So I agree there's a lot of different variables impacting the macro and the market picture today. But what seems to always be mattering most is what investors are facing today. And so we're in the thick of earnings season right now. We're just starting, I think about a quarter almost of the S&P 500 has reported. So we're going to continue to focus on how guidance evolves during this earnings season. We've seen a lot of tail events so far. We've seen this theme of transportation stocks missing, whether it's airlines, American Airlines, Ford today, Tesla, recently, and even UPS. So companies with heavy cyclical exposure to the economy have been disappointing. And to us, that flies in the face of this recent rotation into small caps and risk taking.
One thing I'm wondering about, Michael, is how much more you're going to see volatility rise. You've seen the VIX rise to an 18 handle yesterday. It's holding the ground today. A lot of volatility under the surface, and the S&P 500 right now not figuring out exactly where to go. Is volatility in this market a good thing or a bad thing?
I guess that the answer is it depends. In some ways, it's a good thing for traders and for companies that provide trading as a business, and certainly something that's been missing for much of this year. But it's an echoing of the current uncertainty and this backdrop on the macro front, on the policy front, both in D.C. and the Fed, and of course on the earnings front. So, we've had really low volatility for a while as inflation pressures have come off. Now we're starting to see unemployment rise. So I think the volatility backdrop is not going to spike anytime soon, but we're probably going to settle in at higher levels than what we've seen for much of this year.
I'm looking at shares of NVIDIA falling again today after breaking through a key level to the downside yesterday. And I'm just wondering if we're going to get an answer to whether or not AI pays off this quarter, or if it's going to continue to be a Google kind of wait and see message from all of the companies that report. So much has been invested. Michael, when are we going to see companies monetize it and that show up in earnings?
Well, I still think that's a longer story that goes well beyond. So I don't think we're going to get an answer definitively one way or another anytime soon. Therefore, I don't think that's going to be the ultimate make or break on the story for now. And obviously, we're just early on in the Mag 7 earnings cycle. We've got Microsoft coming up. And so I think we got to wait and see before we can make any longer term judgments on where we are in that cycle.
And Michael, I want to get to the business of forecasting because you made waves earlier this month with Piper Sandler dropping your S&P 500 target, calling that the practice is basically futile in this market. At the time, you said that having price targets on individual stocks makes sense, but makes less sense nowadays for the index. I'm curious, when you take a look at your sell-side community, would you expect that more firms will follow your lead here?
I don't think I'm the first to do that. I believe there's some other strategists over the years that have also avoided that practice. I think there's some firms that kind of have to do it because they have more of a retail exposure to their product. Our firm predominantly focuses on institutional investors, so active managers and stock pickers, where the market, especially given today's concentration, is really less relevant. And I think yesterday was another great example of this, where the average stock in the market was down about 1%, and the index, because of the heavyweight losses in Mag 7, which I think is almost down 17% or so from its peak, made the index go down a lot more. So I think ultimately it's, what we can do to help our clients is focus on which parts of the market to be leaning into and avoiding, rather than trying to forecast an index where the constituents are at a 30-year low in correlations with that index today.
And it's a fair point. I mean, we also heard from Mike Wilson over at Morgan Stanley that he was backing away from big calls such as that one when it comes to forecasting just the index level. But if you are tying this to the concentration of the market, do you see an environment where you return to forecasting the S&P 500?
It's funny. I've been thinking about that and getting that question. And, maybe the right thing to do, again, for my client base is to focus on the equal weighted index, thinking, again, from the opportunity set that institutional investors face. Perhaps that's given today's lopsided concentration makes more sense. But again, we focus on, three things: direction, momentum, and endpoint. And ultimately, whether you're bullish or bearish can come across without necessarily having to have a specific price target. And we're still doing that.
Michael Kantrowitz of Piper Sandler, we thank you so very much. Of course, very complicated market we're taking a look at, on the edge really. But let's take a look at some M&A action because it is a day of mergers as well as IPOs. We're taking a look at Bally's here up on the day because we have Bally's, for example, up 23% significantly because they have agreed to a merger with Standard General, which is the largest common...
as a merger.
An acquisition.
There we go.
An acquisition.
Yeah.
Potatoes. But I agree. Then the other one that we're taking a look at, of course, is KKR agreeing to buy a software firm here, Instructure, for $23.60 a cash. And you have Instructure also up about 2% on the day on the heels of that deal. KKR down about 1%, but earnings ahead still for those big private asset managers. We'll keep an eye on it. All to say, guys, the deals are coming back.
Yeah, absolutely. Just check out MAGO on your Bloomberg terminal to see more on those. Coming up, airlines under pressure. More on the results from American as well as Southwest next. This is Bloomberg. This is Bloomberg Open Interest. Quick check on stocks because we had futures down pretty big this morning, and they turned around after that GDP number came out. 2.8% GDP growth in the second quarter. That is pretty big, considering we were only expecting 2 flat. The S&P 500 unchanged, the NASDAQ unchanged, and the Russell 2000 gaining as investors buy those smaller cap stocks. Katie?
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Citi downgrading Lululemon to neutral. The analyst says that after years of benefiting from outsized growth in the active apparel category, trends have actually slowed, and Citi's credit card data points to a further deceleration. Now, next up, Macquarie is downgrading Warner Brothers to neutral, citing the company losing its broadcast rights to the NBA. The analyst says that losing these key rights means that it now loses a core content assets for both its linear networks and its Max streaming service. And finally, you also have another call from Citi cutting SiriusXM to sell. The firm cites a valuation dislocation, with the stock up nearly 60% from its recent low. Now, Citi says that the recent appreciation in the company's equity may be the result of a short squeeze, Matt.
All right, excellent roundup there. Now, American Airlines shares are tanking, or they were taking a hit, I should say. They've now turned around, and it's pretty eye-opening to see them up 4+% because they slashed their earnings outlook this morning. Southwest as well, changing the way it's going to allot seats and actually reducing seat count as well. There are real problems in the airline industry, it seemed, with pricing power, and yet we see these two climbing on the day. Joining us to talk about why is George Ferguson. He is Senior Aerospace, Defense, and Airline Analyst for Bloomberg Intelligence. George, what is going on that, in the space of an hour after a company slashes its full year earnings outlook, the shares turn around and rock higher?
Also, thanks for having me on. So I think that part of the story here probably is the guidance for capacity in 3Q. And so, what we saw is American, a lot of the U.S. airlines brought a lot of capacity to 2Q. American was in the upper single digits, just levels of growth that the market just couldn't absorb. As we look at their numbers for 3Q, we're actually looking at its growth. I think they're guiding sort of 2 to 4%. So that's something closer in line with GDP, especially, I guess, if the U.S. economy is growing faster in GDP. Southwest was also a growth number of 2%. They're expecting in 3Q. Those numbers are starting to get closer to where they ought to be growing. I don't know that they're going to turn around the pain they saw in 2Q entirely in 3Q with some of this, reduced capacity growth, but I think they'll start to ease some of that pain, and that's probably part of what's going on.
We need to pull up a one-day chart. This is a year of American Airlines, which normally I prefer.
There you go.
A longer-term look. But right now we need to show a one-day chart of what's going on with these shares, because you can see the movement, the volatility has just been pretty large. I mean, we were down at 920 and then we were up at 1080 all of a sudden. So I think the one-day chart, the GIP, which is graph intraday price, is probably the most interesting. That's a two-day chart, which is also pretty interesting. But again, I think the one-day chart is really where it's at today.
And George, another thing beyond the stock price and beyond the numbers themselves, I'm really curious about what is changing with these carriers. You think about Southwest, for example, and them ditching the free-for-all seating, now doing assigned seating. What is all of this really about at the end of the day?
Yeah, so that's part of the, what's going on in the U.S. airline now is that everybody wants to move into sort of premium product. And you might be surprised that premium product isn't a business class seat, right? It's where you sit in the cabin. And so the good carriers are really generating a lot of extra revenue by making you pay up for an aisle seat, make you pay up for a window seat, make you pay up for, an exit row seat. And so Southwest is going to go the same direction. Southwest starting to look even more like the big three, United, American, and Delta. Look, I think this was probably a good change for them, as in they need need to generate more revenue. This is a way to probably generate some of that revenue, separate themselves from the ultra low-cost carriers and the low-cost carriers, and not crush everything that they've sort of, put out there as their product, which is, things like bags fly free, free changes. I think this kind of works for them, as a modification to boost revenue without hitting some more of the sacred items in their lineup.
And George, specific to American, where are they when it comes to business travel, for example? Because we know that the company has been working to rebuild its relationships with corporate customers, with CEOs. Where are they on that journey?
Well, I mean, apparently from today's numbers, not as far along as they should be, right? So they lagged their peers, Delta and United, in every region for yields, right? Yields are the price paid per mile flown. So it really looks like, they've got a pretty decent deficit to Delta and United. Again, Delta United, I think, making better inroads for both premium passengers, premium leisure, and business, and I think that's what's supporting some of their revenue. So we don't get good numbers out of the carriers on how far back business travel is since the pandemic. I think United told us it's about 100% of what it was prior to the pandemic. So there's been no growth since 2020. So there's still a bit of a lag and a bit of a fight for that business travel. And yeah, American doesn't look like it's winning it right now.
George, we thank you so much for your time. That is George Ferguson of Bloomberg Intelligence. Now coming up, we are getting ready for the biggest IPO of 2024. More on Lineage's listing next in today's Wall Street Beat. This is Bloomberg.
This is Bloomberg Open Interest. You're taking a look at the stock market right now, and it's quiet, and that in and of itself is interesting after what we saw yesterday. Of course, the S&P 500 and the NASDAQ 100 falling mightily yesterday. Pretty quiet today. The S&P 500 unchanged. The NASDAQ 100, it had been higher. Now we're trending a bit lower now, down about 0.3%. But the small cap rotation continues. Small caps currently up about 0.9%, maybe helped by what we learned on GDP, really blowing past estimates this morning, Shanali.
And now it's time for the Wall Street Beat, because today we're looking at the year's biggest IPO so far. Logistics giant Lineage makes its public debut today. Joining us with more is Bloomberg's Bailey Lipschultz. And of course, the deal itself last night wasn't bad.
No, it was great.
$4.4 billion. Took a lot of banks to get it done. What is the tone like out there? Is this just a matter of such little supply in the equity capital markets?
Well, Lineage, Sonali, has been a name that has been floated to go public for years. And I've talked to real estate investors who have said, we've met with Lineage over the last 3 years waiting for them to IPO, and now they're finally here. So raising $4.4 billion, they upsized that offering, so they sold far more shares than they initially had been targeting. So a bigger offering, but also priced within the range. So $78, that range was 70 to 82, so upper end, but they didn't push price, and that was the initial feedback I've gotten from talking to some of the buy-side folks.
I think Sonali mentioned this morning that it took 28 banks? Did you say 28?
I did.
28 banks to do this IPO. Why? And all the big names working on it together, right? I mean, nobody's at the top of the tombstone alone. Is that a new trend?
It's kind of where we're at. It seems like that's what we've been dealing with. So when you look back, this is the biggest IPO since ARM back in September. They had more than 20 banks, or maybe 20 banks. We've seen a lot of banks on these deals just because there's not a lot going on. Sure, we're on pace to have year-over-year growth in terms of new offerings, both IPOs and follow-ons, but it still pales in comparison to where we were at even pre-pandemic, pre-2020, 2021 boom.
And we'll be speaking to, of course, the co-founders of Lineage coming up at 10:30 a.m. So maybe you could do some work for us. What should we ask them?
What are they going to do? Because the expectations are, you look at, there's so much uncertainty in real estate right now. And when I talk to folks on the buy side, acquisitions are ripe. So what is the company going to do? How are they going to put money to work? Because they did address some of their debt with this fundraising, but they're going to have some cash to put to work.
Initial stock sales doing just all right. People are still raising money, and now we're seeing that market broaden. What about secondary trading? You look at OneStream yesterday, very exciting private equity-backed company, made it to market, super large pop on the first day, down the next day. What's sentiment like?
Well, that's really, you got to look at the trading. So when you look at this as a company, so OneStream had 11 million shares traded yesterday, so it traded about half the float. So we're still sub 400,000 shares in the first 25 minutes of trading. So giving back some of those gains, the thing, Sonali, that stood out to me was we had a massive sell-off yesterday in tech names, but yet OneStream held on to that 34% gain. We sometimes see this big pops, and then the big question is, does it regress? What does it mean that it regresses to, and what does the next week or 2 weeks look like? Giving back some of the gains, not a big surprise, but the big question is, a week from now, where are we at?
The story we love and that there's a big debate about on the street is Wiz, right? Google offered $23 billion just a couple of months after they had a $12 billion valuation, and they turned it down because they think they can do better with an IPO. The question is, when, and will they have enough cash to invest in the meantime to show the growth that IPO investors demand?
Well, they already said in that letter, their CEO said, we want to get to $1 billion in ARR. So that expectation
and they're
is
at 350 now. And by the way, ARR is like annualized
revenue rate, I think.
Okay.
I'm not a CFA or anything special.
We just throw out acronyms.
Exactly. But the big thing is, when do they get to that? And is that something that has to hit before they go public? But when I talk to people, everyone's excited about 2025 class. Does Wiz sneak into the 25 class, or do they wait to 26? Remains to be seen, but they are growing really rapidly. And when I talk to folks on the buy side, they're super excited about the asset, and they really do think that Google offer likely put a floor on what their valuation could be if they keep growing, and if they keep growing not only organically, but inorganically, because they do want to acquire assets.
30 seconds. One of the theories I've heard out there is that if you continue to see this broadening out, some love actually going to the mid caps, the small caps, it could encourage some companies to come out of the pipeline, actually go public. Does that hold any water with your sources?
Yeah, but the big thing is, Katie, does 1 week make a trend? Does a month and a half make a trend? When I talk to folks on the buy and sell side, they want to see this playing out through the entire quiet month of August, and then maybe we'll have a better conversation after Labor Day. But there's still so much uncertainty from a macro perspective, and also with the election. Weird calendar to go public.
Like the election, you guys.
You should join us more often, Bailey.
This was fun.
Hey, man, I'm always in the office.
Come into the office.
I'm always here.
Bailey Lipschultz there covers stocks for us on the other side of the building. Coming up in about a half hour, we're going to be speaking to the co-founders of Lineage about their trading debut. It's a cold storage REIT that everybody's apparently psyched about. We're also going to talk to the CEO of NASDAQ, Adena Friedman. are 30 minutes into a really weird trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld.
Coming up, stocks stabilizing after a sell-off. Wall Street getting some relief as better than expected GDP data helps ease fears the Fed would need to rush to cut rates.
And here comes this year's biggest IPO. We speak with the co-founders of Lineage as the cold storage firm makes its trading debut.
But before that, a conversation with NASDAQ CEO Adena Friedman. She'll discuss the IPO market, M&A strategy, and much more in just a few moments. But before we get there, let's get a check on these markets on this weird day, as Matt Miller says. You can see the S&P 500 taking a bit of a dive right now. The S&P 500 off by about 0.3%, following through on yesterday's losses. The NASDAQ 100 even more so. Your big tech names down about 0.9%. Of course, had their worst day in about 2 years yesterday. We'll see how, of course, trading today shakes out. And then you take a look at the bond market, that rally there, maybe a haven bid underway. The 10-year Treasury yield currently off by about 5 basis points, Matt.
All right, so it looks like we're heading back down in terms of stocks. Let's talk about it with Lauren Goodwin, New York Life Investments economist and chief market strategist. And Lauren, it looked like, yesterday, the big slides that we saw, the biggest losses on the major indexes since last year, were kicked off by Tesla earnings and Google, both of which really showed that it's going to be a while before AI and robotics start to pay off, right? So that theme that's been powering this market higher in just a few mega cap stocks looked like it was a little bit stale. What's your view?
I think that's really well said, Matt. Our high conviction is that the artificial intelligence trend is here to stay, but I think there's a couple of really important lessons that investors can take away from yesterday. The first is that a lot of the investment that's happening with respect to AI is incredibly capital intensive right now. That costs some of the mega cap tech companies a lot of money. It also means that there might be some beneficiaries that the market is underappreciating. The energy providers, the data and structural providers, these are areas of the market that we think are likely to benefit from capital-intensive nature of this build-out, even if some of the application layer may take a little more time. I think the second thing investors can take away from some of the jitters we've seen in tech the past couple of days is that these trends, even if we expect them to be long duration, interesting for the next several years, they are prone to cyclical events, and that includes just how concentrated that trade has been in a couple of names. All the more reason for investors to consider portfolio diversification strategies, especially if they haven't made any changes in the large run-up in these names.
Well, two things. First of all, really interesting point on AI, that it's still investing in the hardware, the builders, and then in terms of picking winners on the application side, maybe it's a bit premature. But let's talk about diversification, and let's talk about what's going on in terms of this rotation into other sectors, but also into other sizes too. The small caps, it's been impossible to ignore, and it's even today, you have the Russell 2000 up about 0.6%, even as we see some of the bigger benchmarks take a leg lower here. I mean, what do you make about the durability of what we're seeing in terms of this broadening out?
This is a conversation that we have been having on the desk for weeks now. Is the rotation in small caps just about rates moving lower? We saw a similar bump for small caps and value stocks at the end of last year when the Fed was pivoting away from hikes and more towards a plateau. Or is there something a little bit more sustained, what we typically see for small caps on the other side of an economic cycle? In our view, we're not on the other side of an economic cycle. There's still slowing growth to come. And so while I expect that we could see tactical bumps in small caps on months like this, where economic activity is still pretty good, rates look like they're moving lower, but I wouldn't put all of my proverbial eggs in that basket. In fact, when we think about portfolio balance, one of the areas that where we have the highest conviction is using the transition in interest rates that we're likely to see ahead to take some gains in equity and activate them in high yield. We've seen flows into U.S. high yield, including short duration bonds, accelerate over the past couple of weeks. That's a move that makes a ton of sense to me in an environment where the economy is still looking okay, but we're likely to see rate cuts ahead. Lock in those higher rates Still have some price volatility as small caps would, but much stronger yield potential as a result of the coupon.
You know, you think about market expectations, at least one rate cut, maybe two rate cuts. But if you only see one, Lauren, this year, the reality is that rates are still relatively elevated here. So how much does one cut matter? Is there more pain to be had when you think about sectors that are highly levered here when you see through to the end of this year into next year?
It's such an important question, Sonali, and I'm going to take it in two parts. The first is just to acknowledge that even if one rate cut doesn't matter so very much for the economy, which I'll come back to, it matters a lot for market sentiment. And we've already seen some of that transition. Typically, when we see a rate cut, you see money move into the bond market trying to lock in higher rates. You see all kinds of deal flow unlocking in the private markets after a long wait, a lot of fundraising, staleness, not a ton of deal flow. And so you're likely to see, as we've been seeing, a loosening in financial conditions. And that's real. That's real for the markets. That's powering some of the transitions we've seen. And it's real for the economy as well, because looser market financial conditions can provide a little bit of stability. That said, to your very point, higher interest rates, higher policy rates are challenging for more levered areas of the economy, and that can include small caps, which we just discussed. It's our view that the biggest risk actually to the economy and markets in the medium term is if we did see a reversal in rates expectations such that we'd see higher for longer, because that's an environment where credit, which has begun to see some challenges in the economy. I'm thinking lower income consumers, more levered companies, that allows that to continue, which might make an eventual recession more painful.
All right. Lauren, great to get you on the program. I hope you can come and visit us here in the studio soon. Lauren Goodwin there of New York Life Investments talking to us about these choppy markets. Take a look right now at what's going on with the Ford Motor Company after it came out and said huge headwinds in terms of warranty costs. It's not getting as much traction, certainly in terms of margins at the Ford Pro unit that so many people had put a lot of hope in. And obviously it's going to lose a lot of money in Model E. It did better than expected on Model E for the quarter, but they're going to lose $5.5 billion on EVs this year.
Matt, this is the worst decline you're seeing in Ford since March of 2020. I'm going to ask the question Katie keeps asking, do these stocks deserve, banking turmoil, crisis level declines? That's my question.
It's a great point. These are crisis levels, and it's interesting that you're seeing it pull down the rest of the complex as well. GM, even with those good earnings, even with those nuances that we were talking about, GM also down 4.5% right now, Matt.
I will point out that, I often look at the automakers over a 5-year term, and Ford has done better than almost any others. Stellantis, which is also down bigly today, is the biggest winner over the last 5 years, but I think Ford is the second best.
That's your word of the week.
Performer. I know. I really love that the former president made that up.
There you go.
Because it's so much fun to use. Abigail Doolittle, you're watching some of the other stocks. What's moving?
Absolutely. Let's take a look at the shares of NYCB, New York Bancorp, Community Bancorp, back in the news. And for all the reasons it had been in the news earlier this year, once again plunging down about 11%, the worst day since early March, amidst that selling pressure having to do with loan loss provisions that are well above the estimate for the quarter that was, coming in at $390 million versus the estimate of $193 million. For all the reasons before, bad bets on both office and multifamily. In addition, one of their subsidiaries, Flagstar, is selling its residential mortgage servicing business for $1.4 billion. Net, investors not liking it. Let's take a look at healthcare, because a bit of a mixed picture here. AbbVie to the upside up about 4%. They beat and boosted. To the other downside, though, we looked at this one before, Edwards Lifesciences down 25%, the worst day going back to 2000. This after the heart valve maker did miss its sales estimate, what the street was expecting, investors sending that stock lower. As for the overall indexes, it's really interesting. You all were talking about how it's been this wild day. Down, up, down. Well, right now we're down, and this is why. The big tech complex once again dragging. NVIDIA at 107, the key technical level 118. This stock right now technically set to go below 100. The sentiment of that too far, too fast, really weighing on all these big tech names. Let's stay tuned to see if we're looking at another big down day for stocks.
All right, Abigail, thanks very much. Definitely a big down day for Ford. Take a look at the 5-year chart of all the automakers, and Ford has dropped a long way. Stellantis is still up, over the last 5 years, about 35%. Ford, about 20%. So some big moves to the downside today. We'll talk more about those throughout the program. Also, we're going to talk about NASDAQ earnings with the CEO and chair, Adena Friedman. She joins us. We'll talk about the IPO market outlook, as well as their other businesses really diversifying and making a lot more money. This is Bloomberg.
NASDAQ out with its latest earnings this morning, beating on revenue and on profit, and this year's biggest IPO, Lineage, also begins trading on the NASDAQ today. Joining us now is Adena Friedman, Chair and CEO of NASDAQ. And of course, there is a lot of excitement, investor excitement for the IPO market to be coming back, the largest IPO of the year, of course, listing on NASDAQ. What does the pipeline look like? Can you say the second half of the year has more room to run, especially when you have the election ahead?
Well, first of all, thank you so much for having me. It's great to be on your set. And we are really, really proud of the overall results that we've delivered for the quarter with 10% overall growth. We've had 29% growth in our index business and 16% growth in our financial technology business, which, of course, has been an area of real strategic focus for us. As we look at the IPO landscape and the markets part of our business, we've seen slow progression, I would say, in the IPO market. We're coming off of a very tough year in 2023, so we're seeing slow progression. Very excited about Lineage this morning, joining the NASDAQ family of companies. We had OneStream yesterday. So you're starting to see the investor appetite increase for taking risk with the IPOs. But I would have to say that we still think that it'll be slow progression as we continue through the year. The monetary policy outlook and other geopolitical factors, I think, are still keeping investors a little bit more risk they have a little bit more risk aversion. But we're seeing some real good progress, and we think that going into 2025, we should see more momentum in terms of the pipeline of companies that we've been talking to.
When you think about the competition ahead in this market as well, do you think that NASDAQ has an ability to gain even more share? What does it look like behind the scenes? Are you out there courting every 2025 potential right now?
We meet with companies years before they go public. So we really focus on the complete life cycle of a company. When they're early stage companies, we work with them in terms of helping them in the private markets manage their liquidity with Nasdaq Private Market. We work with them on their governance practices and making sure they're maturing their governance. We start to introduce them to investors through our IR services before they go public. And then, of course, they go public and then they become public companies. And that's where we have a whole cadre of capabilities that help them become great public companies. But we're talking to companies well before their IPO plans so that as they think about the public markets, they think about Nasdaq. We had a 72% win rate in the quarter. We're continuing to show that Nasdaq is the venue of choice.
We saw a global IT outage a couple of days ago, reminded the world how fragile things are. Nasdaq was fine, actually, and you offer a suite of IT services to exchanges to guard against those things and financial crimes that I didn't even really know about, showing huge growth. Talk to us about the new businesses that you've diversified into.
Sure, yeah. So with the CrowdStrike challenge, our markets were not affected. The technology we provide to other markets and to the entire financial community were not affected. But of course, you can always learn lessons from those types of situations. And we are partners with our clients. We talk to them and work with them around resilience and redundancy and all of the things that they can effectuate to help manage those types of challenges or at least prevent those types of challenges, so to say. Now, our fintech division is where we sell technology to other exchanges. We have risk management technology, anti-financial crime, regulatory reporting, all the core challenges that banks and brokers face in managing their lives across the capital markets and banking. And that actually grew 16%, as we mentioned, in the quarter. We're seeing a huge amount of demand from our clients. We had 67 new clients sign up for our technology. We had almost 100 upsells and 4 cross-sells, which actually is really starting to show the power of the Nasdaq platform across those vectors of risk.
As we look forward to an election in November and prepare for a slate of maybe new regulations or fewer regulations, how do you think about the outcome of the November election for your clients?
Yeah, we kind of look at the fact that Nasdaq, of course, as a market, we're successful in any administration. I think that Nasdaq as a company, we really focus on managing through political cycles, and we've been here for 52 years. We expect to be here for another 252 years. But I think that when it comes to overall, what are the corporate environment? What do corporates really look for? I think they look for consistency, predictability, and an administration that really fosters growth and innovation, because that really fosters economic growth. And so regardless of who's ultimately in office, can they create consistency? Can they create some predictability in the regulatory environment? And can they put in policies and practices that really drive innovation and growth? I think that's what companies in general look for.
I want to go back to what Matt was asking about, these other businesses that are not IPOs, the financial technology businesses. When you think about artificial intelligence, generative AI, where are you seeing the biggest payoff? Because you look across corporate America and people are investing. So where are the dollars at the end of the road?
Well, first, I would say it's super important to get the right infrastructure in place and the right architecture of your solution. So Nasdaq has been investing in moving all of our technology solutions into a cloud environment now for over 10 years. And that is really paying off, because by doing that, you're modernizing your data infrastructure, you're modernizing your architecture, and you're making it so that you can bring new technologies in faster and you can play, I'd say, offense much more quickly. So a couple of things that we've been looking at, that we've been doing. First is in our markets, we launched something called the Midpoint Extended Life Order, which is an AI-driven order type, the first one that's SEC approved. We've seen a 20% improvement in fill rates and a 20% improvement in our volumes in that order type since we launched that in April. So that's an algorithmic AI capability. And then Gen AI is a new technology that's really come onto the scene very quickly. If you already have all of your infrastructure and data in a cloud environment, it allows you, therefore, then to take those capabilities in. So in Verafin, cloud-based anti-financial crime tool, we launched an entity research co-pilot that automates the process of researching entities that have generated an alert in the system. Takes down the time to do that research by 90%. So it's really a great way to automate more of those workflows. And we have a new one that's come out in our investment tool for asset managers to summarize supervise the pension board meetings, which gives them really quick insights into the strategies of the pensions, allows them with their business development to engage better.
As a CEO, how do you think about future investment in AI, Gen AI? Is most of that investment going toward new technology or retraining your workforce?
Well, we say it's on the business and in the product. So we're quickly launching these capabilities in the product and then teaching our clients how to use them and automate and make it so that they can be more efficient. But then we're also introducing new tools. So we've introduced the Copilot tools for our development organization. We should be fully rolled out across all our developers by the end of Q3. But then you have to educate. And so we've been managing our education throughout the year, making sure they understand how to use them, what is it good for, where do we see the most benefit, and we've had hackathons. We've had over 650 employees participating in some hackathons we ran this quarter, so that you're starting to really get them to understand what's the power of this technology, how can we drive productivity, how can we drive efficiency, but then how do we also create new capabilities in the products? And to us, that's a big part of our future.
I want to ask separately from NASDAQ. You're on the board of the New York Federal Reserve, and we got some pretty stunning GDP numbers in today, 2.8%. We got higher quarterly PCE than had been expected, 2.9%. We got lower jobless claims than had been expected. What's your view on the economy here, and do we need rate cuts?
Yeah, I mean, at the highest level, the economy continues to be quite resilient. Now, we are seeing that inflation is coming down, and so it's coming down and normalizing. You're seeing GDP growth slowing, but still robust, which is fantastic. But you are seeing the higher cost of capital start to impact larger parts of the population. And citizens are really starting to be impacted by that cost of capital. So that's all of, that's an interesting calculus for the Fed to have to manage through. And then with rates at what I would say restricted levels at 5.5%, you do have a pretty big delta between GDP growth and the cost of capital. So there is an opportunity there for the Fed to start to think about how do they moderate that and get that more in line now that even though PCE maybe came up a little bit higher, it's really still coming down quite precipitously from last year.
Do rates and IPOs, is there an inverse relationship there? I would imagine if rates are high, then the cost of capital from private credit lenders is higher and you might prefer an IPO, and the opposite must be true.
Well, actually, I would look at it a little differently. So when investors evaluate a company for an IPO, they look at what is the potential future earnings of that business. And they do what we call a discounted cash flow analysis. And if the cost of capital is higher, they're going to discount the future cash flows more. And so it actually has an interesting inverse reaction where the higher the cost of capital, the lower value they put on future earnings. And that is therefore, I think, had the effect that we've seen on IPOs. Why has the IPO environment been so difficult? It's because the cost of capital has gone up precipitously. Investors have a hard time modeling future cash flows. Now we're starting to think that perhaps the cost of capital could moderate. That makes it easier for them to predict future cash flows. And we actually think that could be a catalyst for more IPOs going forward.
It's a whole market working on that valuation reset. Adena, we thank you so very much for your time. Of course, that is Adena Friedman, Chair and CEO of NASDAQ. And in just a few minutes, we're going to be speaking to the co-founders of Lineage about their NASDAQ debut. Stick with us. This is Bloomberg.
Jobs day like Bloomberg.
All right, let's get a check on these markets about an hour into the U.S. trading day, and pretty interesting. You can see the S&P 500, again, it's off its lows of the sessions, but still lower on the day, down about 0.2%. Big tech really taking the brunt of the selling right now, off about 0.8% on the NASDAQ 100. The bond market maybe catching a haven bid here. 10-year yields down about 6 basis points at the individual stock level, guys. Things are super interesting, particularly in the airlines. You think of American shares currently higher by about 4.5%, despite that disappointing outlook that they gave. I don't really know how to explain the reversal, but as you can see on the screen right now, American up bigly, to steal Matt's word, and Southwest too, seeing some love as well.
Yeah, it's really interesting, and we were talking to George Ferguson, our aerospace and airlines analyst, and he was saying maybe it's about the constrained capacity, because you saw, for example, Southwest say that it's going to take some seats out.
Yeah.
So they've all faced pricing pressures, as have European airlines. But if they constrain capacity a little bit, then they can justify, I guess, at least holding prices at the level that they are now.
Right, and it's moving up into the big lanes. If you could charge more, you make more. I think that maybe that's the end of the story.
Supply and demand, lessons we continually relearn and relearn. Now, coming up, we'll be speaking with the co-founders of Lineage, this year's biggest IPO. That's live from the NASDAQ as they begin trading today. That's up next. This is Bloomberg. It's the largest IPO of the year so far. Temperature-controlled storage and logistics giant Lineage going public in a deal that raised $4.4 billion. You take a look at shares indicated to trade at $80 each. That is above the IPO price of $78. And joining us now, I'm pleased to say, we have Adam Force and Kevin Marchetti, the co-founders and co-executive chairman of Lineage. It's great to have you both with us. And with any IPO that goes public in this environment, we have to talk about timing. So Adam, I'll start with you because there's been chatter about your company for a couple years now. Why now in terms of actually tapping the public markets?
Yeah, look, we set out to build a forever company when we started this, and we never tried to time the market. We just wanted to take good long-term decisions to continue growth at scale, which is what we've been doing. It was just the right time for us to be a public company, to have the right cost of capital, to have the fortress balance sheet, to go out and continue to bring in the best assets in our business and to invest in our customers' growth.
And Kevin, I want to ask what you're going to do with this money that you've raised, $4.4 billion. You think about Lineage, you've made many acquisitions over the past decade or so, 75 in just since 2020, just in the past 4 years. Are we going to see more acquisitions from you now that you have raised this capital?
Yes, certainly. We, as Adam mentioned, we're going to continue to invest in our customers. We're going to build the best warehouses around the world, and we're going to buy the best companies. We're fortunate that Lineage stands for the lineage of our family-owned companies, and we couldn't be more proud to bring more people into the fold. And so we think there's a really exciting opportunity. We've been waiting for this moment for the last few years, and we're ready to accelerate our growth again.
You know, in the world of real estate, warehouses are perhaps the hottest place to be looking at right now. And if you think about where we stand and the demand that you're seeing, what does this mean for your cost of acquisitions? Are you just facing a lot more competition today than you did a couple of years ago?
Well, one thing I'd say, and we've been saying this since we got in the industry, we're bringing the sexy back to cold storage. And a couple other people have found it now. Our little niche is separated from the general dry industrial warehousing space. And we think it's really special to have this fortress balance sheet to be able to really go out and buy the best companies, create the best assets, and then really overlay this amazing piece of technology that our team's built. We touch over 400 billion pounds of food, and the centralized data asset we created really puts us in a unique situation. So we couldn't be more excited about the growth ahead.
I think it's important to note that when families sell their company to us, they're selling us their life's work, their team members, their customers. It's more than just a transaction, and that's been the ethos of our company from the beginning, to create the very, very best home for the very best companies in our industry. That is our lineage, our family pedigree.
One thing I'm very curious about is the process. Norway has committed a very substantial sum, for example, to the IPO, big anchor investor. What was the process like? A lot of people are sitting out there waiting to go public and are finding that those anchor investors in particular help you get the deal done. How important was it to you in this deal?
Yeah, look, we've been privileged to raise a tremendous amount of equity from private investors to date, and in doing that, we've gotten to know incredible investors on the public market side as well. And so, we've got one company. This is what Kevin and I do, and as we thought about preparing for this milestone, it was really about bringing in the very best investors we could that will be long-term partners for the future. And so Norges was an incredible partner through this process, getting to know our business, really spending time with us, and just want to say thank you to them.
Hey, I wonder about your power sources and how important they are to you. Kevin, maybe you take a stab at this one. Where do you get the majority of your power, and what do you do to make sure that you have enough?
Yeah, that's a wonderful question. I think it's really unique. We are one of the few, if only, large users of power that can actually shed load. So if you think about our warehouses, they can be large thermal batteries. So we can cool them when power is cheap and turn them off when power is less expensive. And so we can really help reduce the waste in the energy. And obviously with data centers, there's a huge concern about power. And we really sit in a unique spot. We've actually built our first warehouse that's completely off the grid using solar and linear generators, our partner at Mainspring. So there's a ton of things that we are uniquely set up to do. And as you have the electrification of the grid, we're set up to charge our trucks. And really, we couldn't be more excited about what we're doing to help enable the power infrastructure of not only the U.S., but the whole world.
Adam, when you look forward to the election and the potential regulatory changes, do you think that your business would do better if it were easier, for example, to put up cables?
This has been a durable growth business since we've been in it, and we've been through different cycles and different political environments, and we just do what we do. The food is a global food supply chain. It flows like water, we like to say, and so we don't have a view on it being any different in a different environment here.
People are going to eat no matter who's running the place.
It's a fair point. You definitely need food. And on that note, Kevin, I'll ask you a follow-up. Obviously, the majority of your customers are food companies. But when you look to the future, where are you thinking about possibly expanding? I mean, my mind goes to potential blood storage, drugs, maybe other types of food, such as pet food. What are you thinking about when you map out the next couple years?
You're spot on. There's a lot of stuff we can do. Our focus, 90% of our time is focused on the food industry. If you open your fridge or freezer, that's what we have in our warehouses. We like to say, like, data centers are for technology companies, or cell towers are for cellular industry. We are the food infrastructure. Instead of moving packets of data, we move packets in food. And you mentioned we can do that in the pharmaceutical space, blood plasma. There's all types of ways to use the technology and assets we've built. So we kind of feel like our growth is somewhat unlimited. And that's why being public and having the best cost of capital and the best partners is absolutely critical to continue our growth.
Really curious on how fast you think you can grow. At the end of March, you owned or had a leasehold interest, according to your prospectus, of more than 200 temperature-controlled warehouses. Can you double that? And over what time frame?
We're actually already at 480. And so, look, we think we can continue to grow this business. I mean, since the first warehouse that Kevin and I bought in 2008 to today, we've grown our EBITDA at a 48% CAGR. Look, we built this company for growth. We've invested the infrastructure to bring companies into the fold. We've invested the time and effort to have a team that can develop new assets, including brand new fully automated assets. And so, look, we think we're the best capacity provider and the best owner for this industry.
All right, great to have you guys with us. Thanks so much for joining us. Adam Force there and Kevin Marchetti of Lineage in the biggest IPO that we've seen so far this year. Let's take a look at what's going on in the markets right now, as we've had really an up and down day. Abigail Doolittle has a look at some of the stocks that are moving. Abigail?
Big time up and down day. Not moments ago, I should say, on the NASDAQ 100 down 1%. This after dropping precipitously yesterday, the worst day since 2022. This is a 3-day view of the NASDAQ 100. And here is that dip down to about 1%, down 1% on the day. The recovery now down about 0.5% over this time period, though down 4.4%. So lots of selling. Let's take a look at what's driving some of this action for the NASDAQ 100. And of course, we've been talking about NVIDIA. The reason that we are off of those lows, NVIDIA now at 112 as opposed to 108. But below 118, support is broken. It really appears as though the next level of support, true support, could be sub 100, suggesting that the chip complex and the big tech complex from a sentiment standpoint, too far, too fast, could go further. Plus, Microsoft, Apple, and Meta, we're going to have those upcoming earnings reports, those outlooks. NVIDIA, not until the end of August. So everybody's going to be wondering, can they do it again? Put up another blowout quarter and guide. Until then, it could be a little bit soft. Let's see. And then if we take a look at the NASDAQ 100 in the context of all of this, well, on today, yesterday we sliced below the 50-day moving average. Now we're down on that 100-day moving average. The big question is, back here in April when we had that weakness, we basically went below the 100-day moving average, then back up. However, last October on the sell-off, we went all the way down or thereabouts to the 200-day moving average. Right now, technically, it does look like there's probably some more weakness ahead. And then finally, we would be remiss if we did not include Ford, which is having its worst day since 2009. They missed adjusted profit estimates, as you all know, by about 30%, having to do with higher costs with warranties. Investors clearly not liking this one. Also surprised, Katie, this stock absolutely sliced, gap below its 200-day moving average. There's not a lot of support in sight right now.
Yeah, just brutal to watch. I mean, Ford down 18%, not something you see all too often. Bloomberg's Abigail Doolittle, thank you so much. Now, coming up, the difference between volatility and risk. PGIM CEO David Hunt warns that investors shouldn't confuse the two. That conversation coming up next. This is Bloomberg. It's time now for our daily Wall Street Week conversation, and investors are balancing election risk with an underwhelming earnings season, but there's still one risk that ranks higher. Wall Street Week's David Weston asked PGIM CEO David Hunt why investors should watch out for geopolitical risks.
It may be heightened relative to the last 10 or 12 years, but I would not say it's necessarily heightened relative to the longer-term sweep of history. We've actually had a period of real, I would say, moderation since the GFC in terms of political flashpoints, and it's really been the last few years between the health pandemic, two wars, that we've started to see these reemerge. And I would say it's more of a getting back to normal than it is actually a heightening of the averages. I would also say that I think that this kind of summer of democracy, which we're still working our way through, is only heightening that as well. So I think we have even more geopolitical risk. And indeed, as I travel the world talking to our large institutional investors, their number one risk is geopolitical. It is not what's the Fed going to do. It's not where are we in the interest rate cycle. They really want to talk about the heightened geopolitical risk and what that does for their portfolio construction.
So talk to me, David, about that very issue, the intersection, if you will, between economic growth and the path forward to long-term, because you're a long-term investor.
Right.
How that intersects with the politics and the geopolitics. I mean, how does the politics potentially affect the long-term growth of a Europe, of a Japan, of the United States?
Well, it's really interesting because long-term investors have a very different attitude toward, I think, volatility in general, and that's probably the biggest difference. So I think a lot of the popular media confuse volatility and risk, and they're really not the same thing. So when I say we have heightened volatility, that actually can spell as much opportunity as it does risk. I mean, the only way you lose money is to sell an asset for less than you bought it for or take a permanent impairment. But simply because markets move does not create a loss. And long-term investors tend to look through those cycles, and they use changes in market levels to actually get in at a more attractive price. So as we look forward to the increased volatility, our key focus is, do our clients have enough liquidity so that they can move and move in size when the time is right? And I would say that as people have moved more into privates and more into illiquid assets, that liquidity has become a bit squeezed. And a lot of the work we're doing with clients is to make sure that they have the liquidity so that they can move when the timing is right.
It's one of the things your institutional investors take a look at, your institutional clients, is long-term growth prospects. Because right now it looks like, for example, Europe is different from the United States. Just to take one example.
No, it's a great example. And I would say that we are seeing a pretty big rotation in how people view growth opportunities and where they're putting capital to work. So if you start in Europe, in general, people are quite, I think, pessimistic about growth. The EU is no bigger now than it was in 2018. And it really doesn't seem to be breaking out of the cycle of low productivity and low growth that it's had. Meanwhile, you then go to Asia, and you find, on the one hand, Japan, which is, I would say, in a new, kind of found optimism. They finally have inflation back, which they're grateful for. Growth has come back. They're very constructive about some of the reforms that they've made to corporate governance. And I would say there's more optimism there and about international investors looking in than we've had in a long time. And in fact, I would say that Japan has been the leading country to benefit from the tensions with China, because many people are now building their plants and building their supply lanes around a strategy that's based in Japan. So Japan, I think, is much more positive. China, on the other hand, is probably in a more difficult position. Even last week with the third plenum, we did not see the kind of concerted action that we all thought was going to be needed. So I think people are worried about growth, and they're worried that there isn't going to be a resurgence of consumer spending, which is what's really need to rebalance the economy, but rather continued focus on manufacturing. So there's no new money at the moment going into China. Then you come back to the U.S. And, as difficult, and we like to focus on all the problems of the U.S., actually productivity has looked not bad. Growth is looking, like it's powering through this difficulty. Wages continue to be pretty strong. So, the U.S. is on a relative basis at this point doing very well.
And that, of course, was PGIM CEO David Hunt with Wall Street Week's David Weston. Meanwhile, take a look at the stock market right now in interesting territory. And Shonali, as you know well, a lot of movement under the surface as well.
Yeah, it's pretty incredible. You have the S&P 500 just trying to scrape into the green. The NASDAQ 100 keeping up its losses of about 0.25%, a little more. But some green on the screen in the banks. That's probably my favorite area of the day today. Steepener in the yield curve here. And also, of course, that New York Community Bank sale of a loan book, and the KBW Bank Index up more than 1% now. Stick with us. This is Bloomberg.
Let's get to the trading diary. This is what you need to be watching today and the rest of the week. Israeli Prime Minister Benjamin Netanyahu will meet with President Biden at 1 p.m. Later on, he's going to go meet with President Trump. After the bell, we get Baker Hughes earnings, and we round out the week with the Fed's preferred inflation gauge, PCE, out tomorrow. We got the quarterly numbers out today. We're going to get the monthly numbers out tomorrow. And then the University of Michigan, those Wolverines, have their sentiment and inflation expectations out on Friday, and we pay attention.
And I do want to quickly mention that NVIDIA shares turning positive. They were down 7%. Now they're in positive territory. An interesting market for sure, and an interesting political scene as well, because earlier today, former House Speaker Nancy Pelosi formally endorsed Kamala Harris for president.
It's all over, what's your name? It's all over. That's not how Washington should run. And under Kamala Harris, people's voices will be heard in a very different way than you're trading at the table with big oil, big pharma, big guns, big money. It's about the people.
So better late than never there. Let's talk about with David Gura. He is the host of the Bloomberg Big Take podcast. He joins us on set. And obviously, we all want to know who the running mate of Kamala Harris will be. We got some news on the timeline that it seems like she has until August 7th here.
Likely when it's going to happen, there's going to be this virtual roll call of delegates, which will confirm her as the nominee. So that's sort of what she's shooting for in terms of when that might happen. Obviously, we have this short list, a lot of governors of swing states, a couple of senators. They can seem to move around every day who's at the top of that list and not, but she's interviewing them with Eric Holder, the former attorney general. We'll figure that out in the coming days. And I just commenting on what Nancy Pelosi there said, I think that the reason for her speaking today was she wanted Joe Biden to have the opportunity to give the American people an explanation of why he's done this. We got a little bit on that and kind of situate his presidency in history, had that in that speech as well. But he talked about passing the torch. Now that that's out of the way, I think that she feels liberated to endorse Vice President Harris.
It was on time, too.
Speaking of liberation, well, I had to get to bed.
Yes.
Quickly. Speaking of liberation, does Biden, now that he's not running for re-election, does he feel then liberated to do things differently in terms of policy, in terms of his support of Israel against the Hamas in Palestine, in Gaza? Does he feel liberated in terms of, the more progressive goals that he wants to follow?
So last night in that speech, he talked about what he wants to accomplish in these next 5-6 months, and he was really adamant that he's going to keep working. Of course, there have been calls from all these Republicans for him to step down, that if he can't run, why should he be in the White House still? He wanted to put that to rest. He ticked through all the accomplishments he's made over the last 3.5 years and says he's going to stay the course. He's going to keep working. But on the podcast today, we talked to Nick Wadhams in D.C., and we talked to Ethan Bronner, who's usually based in Israel but is in Washington for this visit. And something we chatted a bit about is, is this the moment for Joe Biden to take a big swing? He's had very little success when it comes to scaling back or stopping the conflict right now in Israel. Could he do something here in these next few months? I think it's really interesting to see sort of if something like that may come out of these meetings. So we have Prime Minister Netanyahu meeting with President Biden today at 1. Kamala Harris comes back from Texas to the White House. She'll meet separately with Prime Minister Netanyahu at 4:30. And then, as you said, Matt, he'll go to Mar-a-Lago tomorrow to meet with former President Trump.
You think about everything that matters over these 100-some days, and you have that polling from Emerson College and The Hill showing that Kamala Harris is trailing Trump in 4 swing states. What's it going to come down to, especially knowing that she herself is going to be meeting with Netanyahu? Is it international policy? Is it the economy? What is it?
So this is a huge moment for her to show herself as somebody who can meet with a world leader like Netanyahu. That's why they're having this meeting in Washington today. But you look at those polling, something that stands out to me is that what's shifted is there are now more undecided
She's going to want to leave
voters.
Netanyahu to Biden, right? She's going to want to let Biden hold that bag.
I don't know.
I don't know. I don't know either. And I think that we don't know enough about her stance on Israel, if it's the same as it was with Biden. We've seen her in past speeches express a lot more sympathy toward Palestinians in Gaza suffering as a result of this conflict. So how she reframes that, how she sort of sets the tone with Netanyahu, and indeed what she says after that meeting will be really fascinating to see. But just to get back to the polling quickly, I think that there's more movement in those numbers now, and that's what the campaign, I think, really wants to take advantage of, is the excitement surrounding her, the donations that we've seen. can she carry that to move higher up in the polls?
All right, David Gura, it's always great to see you. Really appreciate your reporting. That is David Gura. He is the host of the Big Take podcast. We've got to talk about markets right now because we are seeing quite a reversal underway. You look at the NASDAQ 100, your big tech benchmark, and you can see that we've just about erased that decline. It was down 1.6%.
Unbelievable.
Now we're just back to unchanged. The S&P 500, same story, guys, up about 0.2% right now.
I guess when you've got these big concentrations in these, $3 trillion market cap companies, any little move is enough to change the direction of the index, right? So NVIDIA, for example, had been down 1%. It had been down at one point 7%, and now it's up.
All right, we're going to continue to track that. Looking ahead to tomorrow on Open Interest, we've got Katerina Simonetti, Ellen Hazen, and Brian Chesky, the CEO of Airbnb. This is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from London, this is Bloomberg Technology. Coming up, full market coverage ahead as stocks whipsaw after GDP data calms the AI rout. Plus, we turn to the micro picture and sit down with the CEO of ServiceNow on earnings. And we talk venture funding with the CEO of startup Vanta as it raises $150 million with the help of Sequoia Capital. But first, we check in on these markets. We check in
on what was an enormous sell-off yesterday. $760 billion in market capitalization was erased from the Magnificent Seven on Wednesday, a total wipeout. In fact, we saw basically $1 trillion wiped off the NASDAQ 100 more broadly. But today, maybe some signs of calm creep back into the market. We bounce off our lows. We're actually in the green on the major benchmarks, all after what seems to be a Goldilocks reading on GDP. I'm pleased to say for more is Isabel Lee, who can deep dive into what is driving this market. Before it was all AI anxiety, and now it seems to be more about GDP not as bad as we had worried about.
Exactly. We have stocks stabilizing today. We have GDP data that showed that U.S. growth grew faster than expected, which really just implies that the economy is holding up despite elevated interest rates. But I want to bring it back to yesterday, Caroline, because it was a huge reality check. We saw a lot of superlatives. The S&P 500 and the NASDAQ 100 saw their worst days since 2022. And I'd like to think that the tip of the iceberg was really the lukewarm start to the earnings seasons. We have Alphabet with bloated capex, Tesla again postponing the robo-taxi, and investors got thinking, when will we see the ROI of these AI investments? AI, yes, is revolutionary, and it really drove the market to beat one record after the other, but it's not going to happen overnight, and I think that's what they're slowly coming to realize.
It's interesting that we've actually had some decent numbers coming out of, well, ServiceNow we're going to dig into a moment. So there is generative AI revenue in certain areas. But the key question has been valuations, right? There are some great quotes in the stories today just being that valuations just became, well, absurd.
Definitely, and this is why yesterday I was just with a PM and he was like, he's not investing in Tesla and NVIDIA actually, but he likes the rest of the Magnificent Seven or the Magnificent Five, so to speak. So it really just again highlights how this is a stock picker's market, because it's not anymore track the benchmark and see gains. You have to be more nuanced in how you pick. And of course, each portfolio manager has different levels of tolerance. They have different levels of entry points, but traders are now really hedging themselves against wild swings. We have, for example, options volatility in NVIDIA. It's now rising to the highest level since mid-March, and even premium puts for Broadcom also at 3 months high. So investors are kind of more risk off. They're more cautious in how to approach this, because what goes up will not always go up. It will eventually come down, and really that's what we're seeing. But also, we have to note that we only saw 2. There are 5 more to go. Microsoft is scheduled to report on July 30. We have Meta, Apple, Amazon after that, and NVIDIA, of course, on August 28th. So it's still a wait and see for now. I think it's too early to declare that this is the end of the rally so far.
But maybe there are other options, and the options seem to be small caps. Isabel, can you just talk our tech-focused audience around a rotation that is happening in the broader markets?
Exactly. So there has been a rotation in rally for the whole first half of the year. It's been the mega cap tech companies that really brought the market higher. But now small caps are shining. We saw a huge rotation beginning actually when there were the softer reports of the CPI, and we saw small caps starting to shine. And that's really going to be a huge sector to watch out for, because as the Fed cuts rates, and now it's looking to be September, although Bill Dudley, a former New York Fed president, called for in June, which is like July rather, which is like next week. Small caps stand to benefit, and they're really outperforming for the 10th time in 11 days their larger cap tech peers. And a factor of that is the U.S. presidential elections. We know that if we see lower taxes, they will stand to benefit. So again, AI is not the only sector anymore. We see other parts of the market now shining, so to speak.
Volumes, they're higher today, and for now, so are the benchmarks, but only just. Bloomberg's Isabel Lee, we really appreciate the deep dive. Now let's get you a micro picture. ServiceNow actually managing to push away some of the AI anxiety itself by reporting better than expected second quarter earnings on Wednesday after the bell. Increased sales, bookings up. The company also reported, though, that the president, CJ Desai, will be resigning after a probe into the hiring of an ex-CIO of the U.S. Army, Raj Iyer, who had also since left the company. I broke it all down with the ServiceNow CEO, Bill McDermott, just moments ago. Take a listen.
I've been blessed with 25,000 of the greatest women, men I've ever worked with, and they just every day come to work for our customers. And, you know, we built this AI platform for business transformation. And in this moment in time, CEOs need to grow their businesses, and they can't do it unless they simplify their organizations. They're very complex, and you have to clean up the mess to serve your customers and your employees and your innovators better. And they're doing it on one common platform with ServiceNow, powered by Gen AI. And the Gen AI revolution is real for ServiceNow because we built it into our platform. And we have something we call domain-specific LLMs, which means we work with the customer's data. We have zero latency in terms of speed because it's the customer's data, and it's highly secure because it's the customer's data. So we're able to innovate and build net new innovation constantly, and we're constantly releasing this innovation to the market, and that's why our Gen AI business is doubling quarter after quarter, and we're beating and raising guidance, and no one else is doing it. So it's a real thrill.
Let's talk about, and I hate to name names, but some other enterprise software companies. I mean, Salesforce, Workday, they're teaming up to be offering generative AI products. Are you worried about that?
It's perfect. I mean, if you think about it, it's what I just said. They both have, let's call it departmental solutions. You know, one might be focused on the customer, one might be focused on HR, and they have an architecture that's been around decades now. So we use the data in those systems for customers so they can activate this new brave Gen AI world on the ServiceNow platform. Because what good does it do for a CEO to have the sales director optimized, but they are not included in a workflow that deals with the customer from the product that you build to the product that you ship, and ultimately the product that the customer uses and gets satisfaction from. We take the whole value chain into account. If you take HR, you know, it's one thing to have a system of record where, you know, I know my employees and I pay them and I have benefits for them, but it's another thing to recruit them, hire them, onboard them, train them, give them every service that they need in real time, and constantly evolve the generative AI use cases on the mobile so they have a beautiful life. So we just do something different. They do something important too, and our job is to make sure that the customer wins.
Are you taking market share?
Oh, obviously. I mean, if you look at our business, we are the unicorn in the enterprise software industry. I think that one of the analysts on Wall Street put it beautifully today. He basically said that this is an exclusive brand in the enterprise software industry because we're the unicorn. No one's growing as fast as we are. You know, they say you're world class when you grow at the rule of 40. That means your revenue growth plus your free cash flow margin adds up to 40. We're operating in the mid-50s. And we're not only beating quarters, but we're raising guidance as we beat quarters. And that's really because the Gen AI revolution was carefully thought through on our platform. Our brilliant engineers built the best products in the world. Our go-to-market machine's unstoppable. And all the supporting functions in our company and our ecosystem are working for the customer. We come to work for the customer. Whether you're in the private sector or you're in the public sector, we work for you. And I think people really appreciate that, which is why we have like a 99% loyalty rate.
I want to talk about that public sector, and indeed, some of the analysts noting a slight nervousness about what's just happened that's unique to you, and this is in the hiring sphere. And in fact, the president and COO, CJ Desai, has just left the company, largely because of policy violations, we understand. You did a deep dive into what had occurred in terms of the hiring of your head of public sector, Raj Iyer, the former U.S. Army official. Now, for those out there who don't know legalese, who aren't aware of HR details, can you explain really simply what happened and the action you took?
Well, I can tell you what I told the capital markets yesterday. Basically, we received an internal complaint. We take all complaints extremely seriously, especially when it comes to a public sector entity. We love our federal business, and we care deeply about the citizens of the United States and also the service professionals of the United States and how we serve them. We take that extremely seriously. So we elevated that to the board. A special committee of the board was formed along with outside counsel. We investigated all the facts very, very carefully and came to the conclusion that our policy was violated. And we openly reported this to all the entities that are the entities that should have received the reports in the government. And we were proactive with the whole situation. So we have that behind us, hopefully. And, it's one of those things where integrity and our abidance by strict adherence to our policies is just something that we care deeply about in our culture, and we don't grade that on a curve. Tough decisions have to be made when tough decisions have to be made.
Bill McDermott, CEO of ServiceNow there. Let's continue the conversation with Bloomberg's Brody Ford. You broke down the numbers yesterday. You looked into, of course, that hiring and ill-timed hiring, it would seem, who had been the head of the Army in terms of digital transformation. What do you make of that? What's the market making of it?
Yeah, so the person who departed, CJ Desai, he was a big deal, right? This was probably the number 2 person in the company, probably the one who spoke to investors most often at capital markets days, things like that. He was thought of as their product leader. Usually when a sales leader departs abruptly, that's a little more riveting to investors in the immediate because that can mean short-term disruption in sales. When a product leader departs, that might mean more of a long-term disruption in roadmap. So a lot of investors I was hearing from were concerned, but they were more excited about some of the good revenue numbers they saw. So, maybe the CJ departure was not the greatest thing, but it clearly, the stock's up 13% today. It was not enough to ruffle the sentiment too broadly.
Yeah, Morgan Stanley saying, look, does not expect disruptions, but it was surprising. But they are saying that the strength was broad-based across product verticals, geographies. Gen AI momentum is building. Is Gen AI momentum unique to ServiceNow, or are we seeing it on other software plays like IBM?
Yeah, and that momentum, I think, for most vendors is still a slightly open question. ServiceNow spoke heavily about Gen AI helping to fuel the big deals. We didn't get a super clean number about, hey, it contributed this much. During a capital markets day earlier this year, they said it's going to take a while to uplift the top line, right? So it's maybe helping get people excited about the software in general. Is Gen AI alone contributing a lot? It's hard to say. IBM, as you said, they're largely a consulting company. So consulting at this point, all the big companies are going to consultants saying, God, can you help me figure out what I should be buying here? And that's great news for IBM that has a $2 billion book of business in Gen AI at this point.
Yeah, they were specific. They gave a number and they broke it down as to largely that is consulting, but that might shift in terms of the overall percentage differences when we were speaking to the CEO just yesterday. Anything else jump out from IBM briefly, Brody?
Yeah, from IBM, I think the question is, as you laid out, as a consultant right now, most of those Gen AI revenues are in consulting. Over time, does it go to software? Are they able to say to their clients, look, some of the best software you should implement is ding, 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 IBM. And then over time, they continue to use it, and it helps grow in software. Or are they just going to go and use OpenAI models like many others have? That's, I think, what a lot of investors are watching for.
Brody Ford, you have been a busy man. We appreciate you coming on. Thank you so much. Meanwhile, as we head to break, we've been talking about some individual stock movers. Let's look at the broader market. We are being topsy-turvied by the GDP figure. Look, we were down hard yesterday on the NASDAQ. We're managing to claw our way back slightly. We're still off by 2.25% over the last 4 trading days. Remember, massive wipeout of market cap to the tune of $1 trillion yesterday. How much can we push back as GDP comes in looking stronger than expected? This is Bloomberg Technology. talk about the world of crypto. Billionaire Michael Novogratz, Galaxy Asset Management that he has, of course, the unit has just raised $113 million for a venture fund, investing in early-stage startups focused on, you guessed it, crypto software, as well as infrastructure and financial applications. The fund expects to continue fundraising to reach $150 million target next year at the latest. I want to talk about animal spirits in the world of crypto, how tied they are to perhaps a sell-off in big tech. Kavita Gupta's with us, Delta Blockchain Fund General Partner. And Kavita, I want to just go more broadly to what Bitcoin and Ether are up to at the moment, because they have been dragged lower as market sentiment soured. How much is this an alternative asset class? How much ultimately is it still tied very much to equities, to the yen?
I think this market is very interesting because we are continuously seeing a lot of inflows and a lot of outflows. Like ETH ETF got approved, and we saw even on first day a huge amount of money coming into ETH ETFs, around 117 million, which was proposed. But at the same time, we saw Grayscale ETH ETF Trust actually having an outflow of 800 million. At the same time, we saw Mt. Gox, amazing big billion-dollar amount of money getting released. We saw German government selling their Bitcoin, because these are the Bitcoins which were locked when they were priced $100 to $500, and suddenly you're getting them at 65, 64K. So the outflows right now within the space are getting more than the inflows, and that's why we are seeing a lot of volatility in the prices, both for Bitcoin, ETH, and the altcoin rallies, which actually did take off, has sort of plummeted because of the crunch of liquidity too. And as you open the news about different funds raising money in the space, we are also seeing that a lot of them are keeping their fund open to keep on raising, because there is not much liquidity in the space, both for equities or for liquid tokens. So it's been interesting.
What about institutional adoption within this? I mean, when people are fundraising, looking to back startups, where is the LP money coming from? Is it the same sort of institutions that have been backing the future of ETFs, the more broad adoption of crypto as an asset class?
I think at different places in the public market, you have more institutions. In the VC platforms, you are seeing lot bigger fund of funds and bigger institutions like pension funds, university endowments, really coming in multi-billion-dollar funds. But at the same time, in a mid-level fund or small like ours, we are seeing a lot of individuals and individuals like HNIs and big family offices from Middle East, Latin America, India, really jumping on the ground with it. So we are seeing more and more adoption and openness after the ETF approvals.
Very global in its adoption, as you were talking about. But let's bring it back to the United States. How much is there election risk? I mean, we're about to hear Trump speak at a blockchain event, a Bitcoin event on the weekend.
Yes, I mean, it's fascinating, right? The President Trump is coming and speaking in Nashville. There were rumors that Vice President Kamala Harris may show up. I think President Trump has really got there and called himself a crypto president, which definitely has given a huge legitimate eyes to this whole crypto ecosystem, which 10 years back was very speculative, considered very, very risky. But what I'm excited about personally is to see whether Vice President Kamala Harris, what's her views about crypto, because we really don't know. It's a fresh slate. And so that's something I'm excited about over the next 2 weeks to hear. Is this going to be a continuation of White House or no?
Kavita Gupta, great to have some time with you. Delta Blockchain Fund General Partner. We appreciate it. This is Bloomberg Technology. Roblox. Well, it's widely seen as the internet's biggest recreation zone for kids. But is it really safe? As the platform is fighting to keep predators away, a Bloomberg investigation reveals it's not always winning. A message of warning. Some viewers may find the subject matter disturbing.
Social media platforms, gaming platforms, all internet companies have struggled with X-rated content and trying to protect kids or prevent them from being access to it. What's different about this story and this reporting is that we're seeing examples of these cases shifting from the online world into the offline world, where kids are being physically kidnapped, abducted, and sexually assaulted by predators who have connected with them on Roblox.
I've seen so many horrible things happen on Roblox. I've seen games that fully simulate sex with penetration, with fluids. There's been predators who have traveled to meet kids in real life. There's been predators who have transported children hundreds of miles away to their homes.
Roblox has around 77 million daily users, and more than 40% of them are under the age of 13.
Anytime you have an audience where it's mostly kids, predators are going to be in there looking for victims to procure.
Who's ever seen a room full of people laying around in their underpants, like their avatars?
Some really full-on things are happening to kids, and it's subtle the way it starts.
What do you remember him saying to you that was bad?
I remember he would make jokes like, you know, the younger they are, the tighter the hole.
There's predators that will pay children with Robux to do sex acts on camera. And all of this is happening while at the same time Roblox is branding their platform as safe for children.
We've got to start thinking about how we do Roblox differently. It's like going to a place rather than playing a game.
You can view the full documentary at Bloomberg.com. We want to dive deeper into one of the authors of this investigation, Bloomberg's Cecilia de Anastasio. Cecilia, incredibly important work that you've done. And some of the statistics are just horrific. Since 2018, police in the US have arrested at least 24 people accused of abducting or abusing victims they'd met or groomed using Roblox. How is this happening? How is the grooming coming offline? And what is Roblox seemingly doing about it?
Sure. Over 30 million kids under 13 log on to Roblox every day. Parents know it, Roblox knows it, and according to our research, predators know it too. It takes a minute or less to sign up for a Roblox account, and unlike other social media platforms, Roblox allows anyone of any age to sign in. Also, unless parents go into safety settings, kids who log into Roblox are able to chat with anybody, any stranger. So we were interested in understanding exactly how predators were abusing children using Roblox, and we filed dozens of Freedom of Information requests for police documents that explained how predators were doing this. And, you know, some do communicate over those open chats. Others might entice kids into abusive acts using the Robux currency. One pattern we noticed was that some predators would meet kids over Roblox and then move them to another platform like Discord.
jobs day like Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in London. Look, we want to get a check-in on these markets at the moment because it has been a volatile day, to say the least, and week. Let's turn over to Abigail Doolittle. Are we trading higher still?
We are mixed right now, Caroline, but the major averages are higher, and it has been a wild day because at the lows, the S&P 500 down about 0.7%. You can see this index up 0.4%. The tech-heavy NASDAQ, after having its worst day since 2022, and that's true, too, for the S&P 500 yesterday, at the lows today, down about 1.7%, now up ever so slightly. But the dividing factor here is the stocks well off of its lows, but still down about 0.6%. So let's dig into this a little bit more because the major stock really influencing this volatility, well, not surprisingly, it is NVIDIA. Take a look at NVIDIA around the time of the open, down just slightly, but then at the lows, down about 7%. This after falling 7% yesterday. So that would have been, at that point, that it was a 14% slide just in 2 days. A key technical level has been breached and now up ever so slightly at about 115. That key technical level is 118. So long as it's below that level, it suggests that there's more selling ahead. It would not be surprising to see this stock go below 100, basically too far, too fast rally. And the big question is, can they put up another big blowout quarter? We won't know until the end of August. So there will certainly be a lot of speculation, but there will also be some other tech earnings to take a look at to figure it out. Speaking of tech earnings, ServiceNow soaring up 13.4%. The software company put up a very good quarter. They boosted their full year revenue guide. It looks like there's some green shoots there for Gen AI. And then Tesla, all through the day, this very choppy day, has been higher. This after falling yesterday in what was perceived to be a bad quarter. I would argue long term, the quarter was just fine. They beat revenues and that moved toward autonomy. And you can see today up about 3%. Let's take a look at the big drags, though, because there are still stocks down on the day. Microsoft, the second largest company in the world, down 1.4%. And then take a look at these two other chip names down. This helps to describe why, even with NVIDIA up slightly, we have the stocks down with both Broadcom and AMD down. And then